We look at what happened with prices last year and inflation versus other commodities, oil actually remained quite cheap. And if we look in particular at gas and power prices, we had prices for gas at $360 a barrel equivalent, which versus $85 around where we're trading at now is quite low. And the high we reached last year was only $86.70. Now, in the meantime, we have had a comeback in a lot of activity despite Omicron, and we need energy. And the tightness we've had in power and gas has lent itself also to the oil situation. And now we have very low inventories, which during COVID, we had inventories that we had so much oil, we couldn't find places to store it. All of the shipping tankers in the world were being explored as possibilities to store oil. Since August, we have been below the 5-year average on oil inventories. And so now we see that the market has continued to draw inventories. Yesterday in the US, we had a big draw. As a result, the market is realizing, wow, are we not going to have enough oil even at these stronger prices that no one had imagined 2 years ago?
Today we see Brent spot prices falling back a bit, but overall oil prices have been surging in the beginning of this year. How far would you say we are from oil trading at $100 a barrel?
Well, I'd say from a technical perspective, the first target is to beat the October high in terms of the price, which, as I said before, was $86.70. And OPEC Plus is still increasing production every month around 400,000 barrels per day. So we do have more oil coming into the market, but we have this delayed demand reaction. So Omicron came at the end of last year, so we could have already traded up above $90 in the fourth quarter, except that Omicron happened. So now we have a delayed effect in terms of that demand. Our expectation at Pareto is that this demand will come probably already in the second quarter, possibly the third quarter of this year. So the next target after last time's high will be $90. $100 is entirely possible, but the longer the delay in terms of that demand effect, the more US shale can come on board. We have a lot of production coming in shale and a lot of new production coming in Canada. So in 3 months, every 3 months, we get more shale oil. However, the situation now is different from 2014 when we had very low inventories, because the shale explosion will not be relatively nearly as high. We don't expect shale production in the US and overall US oil production to reach 2019 levels until next year, regardless of how high the price trades. So that allows the market to actually continue going higher.
So where do you think the oil price will be at the end of this year?
Probably around where we are now, a little bit lower, maybe around 80, but I think we might have already seen quite a high price surge. And that is because at the end of the year, we'll see that maximum US oil effect. However, I think next year, again, we will have stronger oil prices. And when we look to the next 3 to 5 years, we will definitely be hitting that $100 mark, because when we look at investments, oil is not popular with investments. It's being viewed increasingly like coal. What producers can invest in, they need to look at projects that only cost $50 a barrel, even though we're trading at $85 a barrel, because investors want that extra premium for taking on these dirtier investments. So while shale can come back in the next year and oil sands will still have some production that had been postponed because of COVID, when we look at the rest of the world, we really need higher oil prices. And this is where OPEC Plus will continue defending these high oil prices, because countries like Nigeria need companies to come in and build infrastructure and develop more fields and allow them to participate in the market. And then this is where we're seeing the real super cycle. So the next 3 to 5 years are going to be extremely exciting for oil, even though it is very unpopular from an environmental perspective. And we do see demand peaking, in the next likely 5 years.
You mentioned OPEC, who last week went forward with the expected increase in production in February. Is it possible for OPEC to increase the production even further or at a faster pace to help stabilize the price?
In our view at Pareto, yes, but a lot of the market doesn't actually believe that. And that is part of the premium that we're seeing. And that is because we've seen Russia failing to meet their higher targets. And then we've had outages in Nigeria that have continued. So Nigeria cannot actually increase production the way they are supposed to. We've had unrest in Kazakhstan now, and we have this kind of contagion effect and concern in the former CIS countries with what is going on in Russia. So that's creating a further risk premium. Saudi Arabia, however, can bring in an additional 1 million barrels per day of production when they want to. So we think OPEC will raise production 2.5 million barrels per day out of a market that needs just shy of 100,000 barrels per day of oil, whereas some think that they can't bring that much back.
So to summarize, what are the biggest possible road bumps or struggles for oil coming forward?
That would send the price, keep the price from increasing. The first one is if we get a real variant that affects demand. And this is where we see in China, they're going for this no COVID policy. China is the biggest oil importer in the world. So what happens there can really affect things if they really shut things down. And it will be interesting with the Olympics, because when the Olympics happened last time in Beijing in 2008, the Chinese did not run a lot of their factories because they wanted cleaner air and less air pollution. So they could do something like that again, and especially if they are tying down people and telling them that they cannot travel. The next thing is a surge in US oil production far above expectations. For now, we've had a lot of capital discipline in the US that has kept a lid on US production. So that is the other major one. And the third one is, of course, general economic tightening or monetary tightening by central banks as they worry about inflation.